We've seen the CPI come in line with consensus, pretty much as expected. Your overall impressions first up in terms of what's actually come through here?
The overall impression is good in terms of no change versus the annual rate that was presented for January, but beware, because there is an acceleration in the underlying movement where January's monthly increase of 0.4% became February's 0.7%. That's a big upward move.
And of course hardly unexpected, where we've got those rising oil prices showing little sign of abating, and that clouding the outlook even moving forward. If we drill down even further to that headline number, I mean, underlying figures interesting because it's shown that food inflation is lower and you've got higher core and service inflation figures filtering through. How are you reading that? Because we've had one market watcher highlight that this is important to consider in terms of the speed at which CPI will drive higher moving forward.
Yes, certainly. I think if you look for the danger signals for short-term future inflation, they must be oil and global food prices. Of course, offset by whatever the rand can do to cushion for as long as it can do it. The overall picture, though, is that service prices have tended to be higher throughout this recent downward phase of the inflation cycle, and it's not surprising to find them at 4.5% versus goods price inflation at 3%. The scary number is the administered prices, which are up 9.9%.
But being highlighted is that we've got factors like medical aid contributions, for example, that need to be considered more once-off than anything else, right?
Yes, except that those medical aid prices don't come down again. They are ratcheted in at whatever level they get measured at in February. So I take the point, but they're not going to go away. They're there for good until that particular dipstick is taken again.
Well, that sustaining a trend there. Talking about sustainable trends, let's take a look at that local unit which you alluded to a little earlier. It's cushioned some of the impact of higher prices at this stage of the game. Just how long do you see that currency continuing to play a supportive role?
That's a huge debate amongst economists and financial analysts at the moment. I think that we may be getting towards the end of the huge amount of faith that the rest of the world has placed in the rand, and therefore I would expect the rand to weaken through to the end of this year. There are economists, I'm happy to say, with quite coherent cases who can argue exactly the opposite.
Yeah, so we've got that rand weakness possibly coming through. We've got middle of the year wage increases, electricity tariff hikes to consider, and that all coming to bear on this inflationary picture moving forward. We're sitting on the eve of the MPC decision today, and data seems to, for now, have put a final nail in the coffin for the possibility of a rate cut tomorrow, nor provided a reason to raise. What are your expectations out of the MPC tomorrow?
I'm expecting the MPC to announce no change tomorrow. However, each little bit of data that comes in seems to suggest that the interest rate increases might be earlier in the year than many expect.
Having said that, I mean, we had the SARB's quarterly bulletin reading for the most part positively yesterday, with the current account deficit coming in at 0.6% of GDP. The improvement as a result of an increase in exports as well as a fall off in imports. And you know, while you look at the positive side of that in terms of the current account deficit number, the negative is that lack of imports means, or lessening of imports means, that demand locally, domestic demand, is still struggling.
Yes, I agree. We have seen a fall off in imports, I think more as a result of the slowdown in fixed capital formation spending in the economy. And all I can say is wait till Eskom starts bringing in the big units for the new power stations late this year, next year, into 2013, for the 2 big power stations approaching completion over the next 2 years. And we're going to need lots of capital inflows to counterbalance the outflow through the current account.